Alright, hey, what's up guys? Scott here again with a brand new video, and this one here we're going to take a deep dive into the new June CPI report that came out this morning, and boy is it a doozy. So we're going to briefly go over the major facts of this report and then discuss the major implications of inflation in the US for the stock market going forward. And then also we're going to focus a bit on the energy sector as well, because if we compare what's happening in that sector currently to what happened back in the '08 crisis during the housing market crash, basically, we're seeing a lot of very similar patterns today. So I think what's happening in the energy sector, along with inflation, rising interest rates, etc., is pretty much history repeating itself. And so ultimately, in my opinion, I do think this bear market that we're seeing so far in 2022 is still in the beginning stages, and it's going to continue for quite some time. Now, briefly here before we get started, make sure you guys watch until the end of the video, because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks, and each stock could be worth up to $2,500. And also, if any of you have an interest in joining a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. So make sure to check out the description of this video below, because I do have links to a separate video that will tell you guys all about that Discord and discuss the main features and benefits, and also a link to my sign up page where you can join and you'll begin your 7-day free trial. And then finally here, for anybody who is brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video below. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright guys, so now diving in here, and first off, we'll just go over this article briefly here, which summarizes the CPI inflation report for June very, very well. So obviously, as you can see with the headline, inflation surges by 9.1% in June, which is the most since November of 1981, which obviously, if you do the math there, is 41 years. And so thus far in 2022, I do believe every CPI report that has come out has been worse than the one previous to it. So definitely a very bad sign here in the US economy, and also pretty much everywhere else in the world. And even though the Federal Reserve, of course, has been trying to raise rates to combat inflation, obviously that has not had any impact yet whatsoever. Right, so again, as you can see here in this paragraph, in June, 9.1% increase for inflation as compared to May, where we saw an increase of 8.6%. Now, obviously, these two numbers here are only different by 0.5%, but in regards to inflation, this is a huge difference. And then also you can see that in visual form here on this graph, where starting in 2020, with the massive printing of money from the Federal Reserve, we've seen inflation pretty much skyrocket ever since. And so with that said, we'll continue here. And then also specifically in regards to the energy sector, mostly regarding gas prices, right? You can see the June report's energy index jumped by 41.6% over the last year in June, and thus marking the largest 12-month increase since the period ending in April 1980. Now, that being said though, very recently, which is not included in the June report, we have seen both commodity prices and crude oil fall drastically in the past couple days here. And so that's why you can see here on this line, is there any possible reasons for hope on the horizon? Well, again, in regards to the recent fall in commodity prices and crude oil prices, the supposed good news and hope on the horizon is exactly that, right? So according to Bankrate senior economic analyst Mark Hamrick, this decline in gas prices basically is supposed to be good news in regards to inflation, right? So obviously, with energy prices being one of the main reasons why inflation is so bad right now, then of course it seems intuitive that if gas prices are coming back down, then perhaps inflation in general is coming back down, and perhaps we're out of the woods. But unfortunately, in my opinion, that is not necessarily the case, because if we do compare what happened with energy prices leading into the recession of 2008, we're basically seeing the exact same patterns play out again in 2022. And so in fact, I personally do not think that a decline in oil and gas prices right now is a good thing at all. In actuality, I think it's a indication or a warning that we could be entering a major recession very soon, and you'll see why here in a moment. And also, of course, let's not forget that inflation is actually much worse than what they're saying in these reports here. right? So specifically, if you were to calculate inflation today using the formulas and calculations used in the past, which have been changed many, many times over the course of history, you would see that inflation is actually much, much worse. And I did make a separate video on this topic on the April CPI number. I'll post a link to it above so you can watch it. But also, I'll show you that chart very quickly here as well. And so now, if we come up to this tab right here and we focus on this graph, and so what you're seeing here is a comparison between the consumer inflation, but one graph here in blue is using the 1980 based calculations, and the one in red is using today's calculations. Now, one thing to note here is this graph was last updated back in June 2022, so therefore it does not include June's inflation number, but that doesn't really matter for the purpose of showing you this chart here. And so clearly, as you can see in 2022 with this red line, which again is today's calculations of inflation, right now it's supposedly around 8 or 9% or so. But again, if you were to calculate inflation using the 1980 based calculations or formulas, you would actually see that inflation today is well over 16 or 17%, basically double. And if you do dig deeper into the history of these CPI calculations, you will see that every time the government does change the formulas, it always has the effect of reducing the final inflation number. So ultimately, the reason why I'm showing you this is, of course, number one, so you guys can have the full picture, the full reality of where inflation actually is right now. And then number two, to illustrate just how bad inflation really is. And so naturally, of course, the implications of all this are going to be quite severe in trying to counteract this major crisis. And one of the first major implications of this is we're pretty much guaranteed to see in late July, the Federal Reserve increase interest rates again by another 75 basis points. And that's what they also did back in their last FOMC meeting, which in itself, an increase by 75 basis points was a record for the Fed in the past 20 years. They've never had to increase rates by that much in 2 decades. And so now, of course, they're going to have to do it again in back-to-back FOMCs. And ultimately, if we come over to Thinkorswim real quick and take a look at SPY, which is an ETF that tracks the S&P 500, we'll zoom in here a little bit. Right, so obviously here, it's no secret by now that we're in a major downtrend in the S&Ps and pretty much every other stock index in the market. And that's mostly because rising interest rates, especially at record paces, is typically not a bullish thing for equities. Right, rising interest rates makes money much more difficult or more expensive to borrow. And since most companies borrow money nowadays to grow and expand their company, obviously growth is going to slow down. That's the whole point. Right? Because essentially inflation occurs when the economy is too hot, so to speak, when there's just too much spending and too much money overall in circulation in the economy. That has the effect of drastically increasing prices. And of course, we have the Fed to thank for that because they were the ones printing literally trillions and trillions of dollars ever since COVID and injecting that money into the economy to try and stimulate things. Right, so literally the main reason why the economy and the stock market rebounded so quickly after the COVID crash is because of what the Federal Reserve was doing. And so in fact, if we come over here now, we can see the actual Federal Reserve's balance sheet in blue compared to the S&P 500 index. And ultimately, I think it's very, very obvious what happened here. This was the COVID crash back in 2020, and pretty much right at the bottom of the crash, look what happened to the Federal Reserve's balance sheet. It went literally from $4 trillion at the bottom of the crash all the way to over $7 trillion in the span of just a few months here. So bottom line, what this means is the Fed literally printed over $3 trillion plus a whole heck of a lot more after that to try and stimulate the economy and of course keep equities afloat. And this here really is the main reason why we're seeing such incredibly bad inflation to begin with. The Federal Reserve caused this problem with too much stimulus, and now they're trying to take back a lot of that stimulus by increasing interest rates and removing money from the economy. So basically, as of June of this year, just last month, they've announced they're going to begin what's called quantitative tightening, which basically means they're going to be reducing their balance sheet and trying to, again, pull money out of the US economy. And ultimately, the way they do that is by increasing interest rates through the sale of lots and lots of bonds, which were the very same bonds they were acquiring all through COVID and printing trillions of dollars to actually pay for. So bottom line here, if all this crazy amount of ridiculous printing and stimulus caused the market here to go up pretty much every single day since the bottom of the crash, then what do you think is going to happen once they begin to unwind all of that stimulus? Well, I think it's pretty obvious that the market is going to continue a major downtrend. And then lastly in this video, what about energy prices as well? So one more time, we'll come back to Thinkorswim here, and we'll go over to XOP, which is an ETF that tracks the oil and gas sector. And so as you can see here, this is what I was referring to at the beginning of the video when oil and gas prices were coming down drastically in the past couple days here. And this supposedly is the good news about the end of inflation. But that being said, if we change the time frame on this chart and we go to perhaps a max weekly chart, let's now take a look at what happened to XOP back in the 2008 crisis. So we'll zoom in right into this area here. And so this line marks the end of the year 2007. So everything to the right of this line is 2008. And pretty much right at the beginning of 08, the market, the S&Ps, were steadily going downward as they are today. But during that time, what was energy doing? Going straight up. But eventually things topped out and came crashing down. And ultimately, it was around this time frame, pretty much towards the end of 08, where the S&Ps reached their lowest point of being down by more than 50%. And so same thing if we fast forward to today's prices for XOP. So again, right here is the beginning of 2022 with this line. And once more, pretty much since the beginning of 2022, the S&Ps have been steadily going downwards, while at the same time, energy prices have been skyrocketing to the upside, at least for a time. And then now, just like back in 08, energy prices are finally beginning to collapse as well. So bottom line, the prevailing idea around this is that, during times of inflation, of course, energy prices are not going to be excluded from that. So they're going to increase in price drastically, as we've seen with gasoline in particular. But eventually, if things become more and more likely that we're going to reach a major recession, then at that point, energy prices typically come back down. Right? Because ultimately, supply and demand, for the most part, still runs the markets. So during recessions, the demand for energy comes way down, as we saw back in 08. So therefore, of course, the prices of energy, gas, oil, etc., has to come down and meet demand as well. So given our current situation with inflation out of control, rising interest rates, and a likely recession on the horizon, then decreasing energy prices is not a bullish or a good sign. It's mostly a warning that, yes, indeed, we are going to enter into a major recession. And so with that being said, take my opinion here for what it's worth. Of course, I definitely could be wrong about this. I kind of hope I am, because recessions are not a good thing, right? But again, ultimately, what I'm seeing here on the charts and by analyzing the 08 crisis, again, we're seeing a lot of the same patterns play out again here in 2022, except unfortunately this time, the Fed's balance sheet is way more out of control than back where it was in 08. And of course, also inflation is much more out of control as well. I mean, again, we're seeing 41-year highs in inflation. So that goes back to the 1980s, not just back to 08. So ultimately, if we do enter into a recession, I think this one could be one of the worst ones in a very long time. Just my opinion. So again, take that for what it's worth. Now, lastly, here in this video, as I mentioned, I do have a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering the opportunity for you to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and sign up for my options trading Discord, as well as my SKILLSHARE courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.